Soden, your North Alabama Realtor, Associate Broker, and Team Leader of the Soden team with Legend Realty.
And I'm Kat Frisby, your friendly neighborhood mortgage loan officer, also known as the Tattooed Lender with Victorian Finance.
This is the show where we help you reach the home stretch of your real estate journey. Whether you're buying, selling, or just curious about what's going on in the housing market.
Today's episode is a big one. We're diving into interest rates, what they really mean, how they're determined, and most importantly, how they impact your buying power.
Because let's be honest, when you hear that interest rates have gone up or down, it can sound like background noise. But those small percentage points can make a huge difference in what kind of home you can afford.
Exactly. So grab your coffee or your calculator and let's break it down together.
Okay, Kat, let's start with the basics. What exactly is an interest rate and why should buyers even care?
Great question. An interest rate is basically the cost of borrowing money. When you take out a mortgage, you're borrowing a large amount of money from a lender, and the interest rate determines how much extra you'll pay over time for that privilege.
So it's like the price tag on your loan.
Exactly, and that price tag can fluctuate depending on the market, inflation, the Federal Reserve, your credit score, loan type, and even the size of your down payment.
So when people hear the Fed raised rates, they think, oh no, mortgage rates are going to go up. But that's not always the direction. They're directly tied to that, right?
No,
Yeah.
Right. So the Fed rate influences mortgage rates, but it doesn't set them. Think of it more like a ripple effect. When the Fed adjusts the rates banks use to lend money to each other, it eventually affects mortgage rates, credit cards, auto loans, and more.
Okay, now for the part that hits home. Literally, how do interest rates actually affect what buyers can afford?
So here's the simple version. When rates go up, your buying power goes down. Let's say you're approved for a monthly payment of $2,000. At 5%, that might get you a $400,000 home, but if the rate jumps to 7%, your same $2,000 payment might only cover about a $325,000 home.
Wow. So that's just 2% increase in interest rates can cut your home budget by $75,000.
Yeah, it's wild. That's why understanding why you should lock in a good rate makes all of the difference.
And that's where strategy comes in. Sometimes it's worth it to buy now and refinance later rather than waiting and risking higher prices or missing out on the home you love.
Exactly. We say it all the time. Marry the house, date the rate. You can always refinance down the road when rates drop, but you can't always go back in time and buy the same house once it's off the market.
Okay, let's talk about what actually determines your interest rate because it's not one size fits all.
Totally. So here are the big ones. Credit score. Higher scores mean lower risk, which means better rates. Down payment, the more you put down, the less you have to borrow. Loan type, conventional, FHA, VA, each has its own rate structure. Debt to income ratio, lenders look at your ability to handle monthly payments. Market conditions, supply, demand, inflation, and investor confidence all play a part.
So it's kind of like a recipe, and your personal financial situation determines the ingredients.
Exactly, and that's why it's so important to talk to your lender early on in the process, even if you're not ready to buy right now. I can help you build a strategy to improve your credit score and save more, so when you're ready, you get the best rate possible.
And I love that because as an agent, I can help you match that financial readiness with the right home and neighborhood for your goals. Let's make this a little bit more real, Kat. Can you walk us through a quick example?
Sure. So let's say you're buying a $350,000 home with 5% down. At 6% interest, your monthly payment, principal and interest only, would be around $2,000. At 7.5% interest rate, that same payment jumps up to $2,300. That's $300 monthly difference, or $3,600 more per year just from a rate change.
That's like adding a used car payment to your budget, and it really highlights why even a small change in rates matters so much.
So here's the takeaway. Interest rates don't have to scare you. They just need to be understood.
Exactly. Knowledge is power, people, and working with the right team, your lender and your realtor, can make a whole process less stressful and more strategic.
If you're thinking about buying, don't wait for perfect rates. Focus on what fits your budget today. And remember, rates are temporary, but real estate is a long-term investment.
Very well said. All right. Thanks so much for tuning in to the Home Stretch.
If you found this episode helpful, don't forget to like, subscribe, and leave us a review. It helps more buyers and sellers find our show.
And if you've got questions about buying, selling, or just understanding the market, drop them in the comments. We might answer them on a future episode.
I'm Kat Frisby with Victorian Finance.
And I'm Nina Soden with the Soden team of Legend Realty. Thanks for joining us, and we'll see you next time on the Home Stretch.